All right, everyone, let's dive into the world of dividend stocks in Singapore. We're talking about companies that love to share their profits, and we're honing in on 10 Singaporean companies that Simply WallSaint has flagged for us.
Yeah, and we're not just looking at the surface here, we're going deep. Unpacking what makes these companies tick, their dividend histories, and whether those payouts are on solid ground or if it could all come crashing down.
Okay, so imagine we're looking for companies offering not just a nice dividend right now, but sustainable payouts down the road. Where do we even start?
Well, Simply WallSaint has done some digging and ranked these companies for us based on factors like their dividend yield, their financial health, and their future prospects. They even give each company a star rating. It's kind of like a Michelin guide, but for dividends.
Okay, I'm intrigued. Who snagged those coveted 5 stars?
Well, first up, we've got BRC Asia. They're a construction company with a 6.69% dividend yield.
Construction. Not exactly the first industry I think of for reliable dividends.
Right. It's not the usual suspect, but BRC Asia seems to be weathering the storms. See, construction is often seen as a cyclical sector, so it's really sensitive to any economic ups and downs. But their consistent dividends over time, that suggests a strong financial foundation.
I see, so they're like a sturdy ship in choppy waters.
I like that.
Who else is in this 5 star club?
Next, sticking with those impressive yields, we've got Bumatama Agri. They're a big player in palm oil production with a 6.41% yield. Agriculture, as they say, is the backbone of any economy.
True, people always need to eat. What about a company everyone knows, Singapore Airlines? They must be on the list, right?
You bet. Singapore Airlines has also snagged a five-star rating with a soaring 7.38% dividend yield.
7.38%. Now that's what I call flying first class in the world of dividends. But the airline industry, it's always so up and down.
You're telling me. That's the big question mark here, isn't it? While that yield is super tempting, investors really need to think long term. How's the airline's overall financial health? Can they keep those payouts coming?
All right, point taken. Who else is on our radar then?
All right, let's look at YHI International. They're a key player in the automotive world: tires, alloy wheels, battery products. They're offering a 6.43% yield.
Solid yield. But with electric vehicles taking over, I wonder how that impacts a company so focused on traditional car parts.
Exactly, it's a valid concern. But their dividend history suggests they've been navigating the changes well so far. Still, investors need to dig into their long-term strategy for electric vehicles.
Right, because what worked yesterday isn't always what will work tomorrow. Who else should we be looking at?
Let's switch gears completely and talk about Singapore Exchange. They operate the Singapore stock market and are offering a 3.07% yield.
3.07%. That's lower than some others we've talked about. But I guess owning a piece of the stock market itself, there's a certain stability to that, right?
Exactly. It's not about chasing the highest yield, but finding that balance. Singapore Exchange represents stability, consistent profitability. It's a different kind of play for investors who are in it for the long haul.
I see what you mean. So who else has earned a 5 star rating on Simply WallSaint?
The last one in the five-star category is QAF Limited. They're a huge food manufacturer in the Asia-Pacific region, offering a 5.99% yield.
Food. Yeah. Always a safe bet in my book. People always need to eat, no matter what's happening in the world.
You got it. And QAF Limited's dividend history. It shows they've been able to handle those changing consumer tastes and stay profitable, which is key for anyone looking for steady income.
Okay, so we've covered the 5 star companies, the ones that really stand out. But I have a feeling there might be some hidden gems among the 4 star companies too, right? Should we take a look?
Let's do it. Those four-star companies, they might just hold some hidden potential.
All right, let's uncover those potential hidden gems. Which 4 star company is first up?
Okay, so first up in the four-star category, we have Aztec Global. They're kind of behind-the-scenes players in the tech world.
Behind the scenes, how so?
Well, they design and make electronic products, but for other businesses, not directly for consumers. And get this, they're offering a 9.9% yield.
Whoa, 9.9%. That definitely gets my attention. But tech, I mean, it's notorious for being volatile, right? How sustainable is that kind of dividend?
Yeah, that's the million-dollar question with a yield that high. Investors really got to do their homework. Are Aztec Global's financials solid? Who are their clients? Can they keep up with all the changes in tech? It's a fast-moving world.
It's like they're trying to outrun a tsunami of change, right?
Yeah.
Okay, so high yield, but also high questions. Who's next on our 4 star list?
Let's move from the tech world to something a little more, shall we say, fun. Genting Singapore, they're big in the hospitality and entertainment scene, 4.73% yield. They own and operate Resorts World Sentosa, which you might have heard of.
Oh, Resorts World Sentosa. I've heard good things. Lots of entertainment options over there.
Exactly. But, the hospitality industry, it can be as unpredictable as, well, a casino.
True, true. What does their dividend history look like?
Well, their history and their current payout ratio are decent, not flashing red flags or anything. But investors need to be aware, right? Tourism trends, economic conditions, even pandemics.
Yeah.
Those can all impact their bottom line and ultimately their dividends.
Right, it's all connected. So even the most tempting dividends, you got to look at the bigger picture. Who else is a potential hidden gem here?
Let's talk about a big player in the Singaporean economy, Overseas Chinese Banking Corporation, or OCBC for short.
OCBC.
One of the big three banks in Singapore. They're offering a 5.71% yield.
Banks aren't usually the most exciting investments, but they can be solid, right? Long-term plays.
Yeah, exactly. Banks are often seen as a good indicator of how the economy is doing overall. So OCBC's performance, including their ability to pay those dividends, it's tied to economic growth and interest rates.
So many factors to keep in mind. All right, we've got one more four-star company on our list, right? Who have we got?
Last but not least, Delphi. They're a major chocolate confectionery company, headquartered in Indonesia but listed on the Singapore Exchange. And their yield, a sweet 6.54%.
Delphi, I know them. Who doesn't love chocolate? But how does a chocolate company fare in the world of dividend investing?
Well, food, especially something as universally loved as chocolate, tends to be a pretty resilient sector. Even when other industries are struggling, people always want their chocolate, right? Delphi has a solid dividend history, strong presence in the Southeast Asian market. They've been satisfying sweet tooths and investors for a while now.
I like the sound of that. Okay, so we've gone through a pretty diverse range of companies today, each with its own strengths, risks, potential rewards. What's next?
All right, so how about we turn our attention to a company I think we all know, especially if you've ever flown into Singapore. Singapore Airlines.
Singapore Airlines. They're iconic. It feels like we saved the best for last, but even for a big name like that, a little refresher never hurts. What can you tell us about them?
So Singapore Airlines, with their subsidiaries, they're a major player in air transportation globally. They've got the well-known Singapore Airlines brand, and then there's Scoot, their low-cost carrier. Their market cap is a hefty SGD 23.17 billion.
Wow, that's huge. Okay, and their revenue streams. I imagine those long-haul flights are where it's at, right?
You're right, their full-service carrier operations brought in SGD 16.18 billion. Scoot brought in SGD 2.45 billion. But get this, their engineering services division, they handle maintenance and repairs, and that pulled in SGD 1.09 billion.
Wow, I had no idea their engineering side was such a big contributor. That's fascinating. But let's talk dividends. What's their yield looking like these days?
Hold on to your hats. Singapore Airlines is currently offering a 7.4% yield.
Wow, 7.4%. That's sky high. But with the airline industry being as unpredictable as it is, what does Simply WallSaint say about their overall dividend performance?
Well, they've earned a 5 out of 6-star rating from Simply WallSaint, which is really good. And they just announced a final dividend of SGD 0.38 per share.
Okay, so they're sharing the wealth. But is that sustainable? Are there any potential bumps in the road we should be aware of?
Well, their payout ratio, based on earnings, is sitting at 75.9%. If we look at their free cash flow payout ratio, it's a bit lower at 45.9%. What this tells us is that they're using a big chunk of their earnings to fund those dividends. Something to keep in mind, but not necessarily a reason to panic.
So they're putting a lot of their profits back into the pockets of their shareholders, which is good.
Mm-hmm.
Anything else stand out from Simply WallSaint's analysis?
Here's where it gets interesting. Even with the good dividend yield and the positive rating, Simply WallSaint actually suggests that Singapore Airlines might be undervalued by the market right now.
Really? So there's potential for growth and income. That almost sounds too good to be true. What's the catch?
Well, remember we talked about the cyclical nature of the airline industry. Singapore Airlines' dividend history, it's had its ups and downs. Payouts haven't always been consistent. And while they're doing great now, there are definitely concerns about potential earnings dips down the line.
Right. Nothing is ever guaranteed, is it?
Yeah.
It seems like every investment opportunity has its own set of things to consider.
Well, we've covered a lot of ground today, from construction with BRC Asia all the way to the luxurious flights of Singapore Airlines. It's been quite the journey through the world of dividends in Singapore. Any final thoughts for our listeners, especially those who are thinking about building their own dividend portfolios?
It's been great taking this deep dive with you. And remember, everyone, this is just the first step. Before you invest in anything, do your research. Don't just get dazzled by those big dividend yields. Look at the company's overall financial health, how they stack up against their competitors, and don't forget about the bigger economic picture.
Great advice. And here's a final thought for our listeners as they start exploring these companies. Think about how Singapore's push for innovation and its place as a global financial hub might impact how these dividend stocks perform in the future. It's a tough question, no easy answers, but definitely something to ponder as you dive into the world of investing. Until next time, everyone, happy investing.
Happy investing.